Okay. Good morning. My name is Garrick with eXp Realty, and today we're talking about real estate math. I know this is not a very sexy or a very interesting sounding workshop, but at the end of the day, numbers do matter. And we're going to go have a pretty high level discussion about it because it matters to your business and it matters to your client's business, especially if your client is an investor. Okay, so let's get started. We're gonna go through the basics. And the most basic thing is going to be understanding what a percentage is. A percentage is right here. It's to calculate the percentage, move the decimal 2 spaces to the left, which is the equivalent of dividing a number by 100. The word percent is short for the word per cent, which literally means for every 100. Okay, per means for every, cent means century for 100. So it just means divide by 100. Okay, so 1 divided by 100, or actually 100 per 100 means 100 out of 100, which just means 1, a whole, the entirety. 75% means 75 out of 100. So 75 divided by 100 is 0.75. So for practical purposes, if you just take 75 and move the decimal 2 places to the left, you get the equivalent of dividing it by 100, which is 0.75. Here, I've included some of the most common percentages in converting to decimal. And this way you can use these numbers in your head very quickly. Okay. Also going to be very important is the opposite of, or what is the remainder, right? For example, if you've got 75%, if you're bringing 75% of the purchase price as a loan, that means 1 minus 0.75 is 0.25. The remainder of your balance is 0.25. Okay. So if you've got a 75% loan, that means you're bringing 25% down payment. If you're bringing a 20% down payment, that means your loan is 80%. Okay. So those things need to add up to a whole 100%. Okay. This is that's working on percentages is the foundation to these understanding these numbers. The most common numbers we're going to work with, especially as agents, when you do your calculations on taking your business, is 2.5%, or at least in California. Okay, typical buyer's agent commission, and I'm not talking price fixing or anything that's anti-competitive. Everything's negotiable. Okay. Typical sellers are offering buyer's agents 2.5%. So if you take 2.5, even the percentage has a decimal in it, right? 2.5 divided by 100, you're going to end up with 0.025. Okay. So these are the common decimals that we have to look at. All right. So let's take a look at commission. Okay. So if a listing commission is negotiated between, that's my disclaimer. Okay. It's not price fixing, and we're not setting a standard. Listing agents, do your thing. Buyer's agent, do your thing. Negotiate what your fair price is for the work you got to do. Okay. This is not a fixed amount. Okay. So let's say the sale price is $1 million and the listing commission is 5%. So let's say the listing agent decided to go talk to the seller and say, yes, I believe your condo is worth $1 million. And for me to sell it will be 5%. Okay. That is my cost. Okay. So to calculate that, the listing commission is 5% of $1 million. And I used to be a high school teacher and a math teacher. And I like to make that connection that math is a language. Okay. It is a numerical language. And these symbols that you look at, these numbers, it is a type of alphabet. Okay. You might call me crazy, but that's okay. But this stuff actually translates into English, right? So for example, when you say 5% of 1 million, that literally means 5% is 0.05, of means times 1 million, write it out. it's $50,000. Okay. So you, as the listing agent, listing a property for $1 million for 5% commission, I will agree to sell it for 5%, is $50,000. But you, as the listing agent, especially in California, because the whole United States, we co-op our commission with a buyer's agent. So a buyer agent comes in and the listing agent cooperates with the buyer's agent and generally splits the commission 50-50, but it doesn't have to, right? So if the listing agent is doing more work, maybe they're overseeing a renovation, maybe the listing agent's doing other things such as, coordinating contractors, or then maybe they negotiate a higher fee for themselves. Maybe the listing agent's earning 3.5% and buyer's agent's doing 2.5%. So it's a total of 6%. Your market is different. Do what's right for you and your client and go for it. Okay. The buyer agent co-op is 2.5% of 1 million. Okay. So 0.025 times 1 million is 25,000. So the listing agent is earning 50, but is going to share 25 of that with the buyer's agent. So at the end of the day, they each make 25 each. Okay. And this is where you're going to have to figure out how to explain your message to your client. Okay. You're going to say, that's a lot of money to take 3 pictures and put it on the internet and put a sign and hold an open house and say, wow, I'm done. But if that is all you do to sell a property, then I think you've totally missed the point. And you have not explained to the client what your value is, because then why couldn't the seller do that? The seller could do that and save themselves $50,000. Okay. So let's take a look. What do you do? And that's a different discussion. Okay. So what do you do as a listing agent? What do you do as a buyer's agent? It is a different conversation because that's where you have to explain the value that you provide. Okay. So listing commission, $1 million, 2.5% is 25,000. That's your gross commission income. And everybody compares gross commission incomes. Like, hey, our team sold $50 million. But the next question is, how much of it did you keep? Okay. So gross commission income is one metric, but ultimately it's going to be how much did you actually keep? Okay. So these are things that you might have to explain to your client in terms of where that money actually goes, because do you actually keep all 25 of it? Usually not. Okay. You can get close, but usually it's not 100%. Okay. Subtract concessions. So let's say during the course of a transaction, the buyer comes in, the buyer submits a request for repairs and says, the refrigerator is broken and we'd like $1,000 credit for a new refrigerator. And the seller is very stuck on it and says, I'm not going to move. I'm not going to budge off of $1,000. And let's say both parties are deadlocked and they don't want to give up money. Then if you feel that it's the right thing to do, you can offer that to the seller and say, you know what, it's still a good deal. It allows you to move on to your next, downsize, upsize, move across the country, whatever. It allows you to do your thing. We can get the transaction done. The buyer's committed, but we're fussing over $1,000. How about I contribute $1,000 and call it a day? Okay. That is called a concession. Maybe you negotiate it and say the buyer has to do it, or maybe the buyer's agent contributes, or you split it half 50-50 with the buyer's agent. Okay. So if that's the case, $25,000, you give in 500, you're still doing all right. It's not a bad deal. Okay. Maybe you're giving up 1,000. So you're earning 24 on that one. That's called the concession. Okay. Subtract referrals. Maybe this lead came from a third-party source, or maybe it came from a fellow agent in a different market. So I received a buyer lead from a colleague within eXp Realty. So somebody I know in LA sent me a lead and said, okay, hey, this is my past client. I'd like for you to take care of my past client. And would you, if you close it, could you send me a 25% referral? So that would be like 25% of the gross commission income now goes paid directly to the referring source. Okay, that comes off the top. Okay, so then let's say if it's so 25% of the total commission goes to that referral source. Could be Zillow, could be Opcity, could be Redfin, could be any other referral source. Okay. Let's say, okay, so for the practice of this conversation, I did not calculate any of these values in here, but you could. So for example, 1 million is 25, then 25 times 0.75 because you have a 25% referral to these, or 0.7%, 0.7 because it's a 30% referral. Okay. But let's take a look at it this way too. Okay, let's say you're working on a team with a team. So 25%, 25,000. The agent keeps 75%. Okay, because it's a 75-25 split with the team. So the agent keeps 75%. And then after that portion, so this is equivalent to that referral. So if it's a team or if it's a referral, this would be the similar to be how it's calculated. Then maybe your brokerage has a split and you need to pay 20% to the brokerage. Okay. So in that case, you take that number and then you times it by 0.8 because you're paying 20% to the brokerage. Okay. So in this case, now you're down to 15. So right off the top, it seems like 25 is a great number. And now we're down to 15. And then maybe you do other stuff, like maybe you buy company equity and you're down to 14,250. And then you're still not done because now you had to pay Uncle Sam. Okay, you're an independent contractor. You do not pay taxes. I mean, your employer does not take the taxes away from you to pay the government. You have to do that yourself. You do that in terms of estimated taxes, quarterly taxes, and then you're left with 9262 spending money. Okay. The government doesn't take this. You have to send it in yourself. Okay. That's like, this is assuming 35%, but you should practice good accounting. Okay. So if you spent all 14,250 of this at the end of the year, you're not going to have money to pay Uncle Sam. So it's best that you do good financial practice and put money into different accounts. I set up 3 accounts. I put one account as personal salary, which is 1/3 of the, so in this case, I'd put like 5,000 into salary. I'd put 5,000 into Uncle Sam, and then I'd put 4,000 into the business. Okay, so set up three savings accounts, or 1 checking account and 2 savings accounts. Okay, so break it up into thirds. Okay, so 5 for salary, 5 for Uncle Sam, and then 4 for the business. Okay, so the business would be doing things like paying for staging, photography, inspections, closing gifts, marketing postcards, flyers, cleaning, home warranty. Okay. They could go for that. You can negotiate these costs into the transaction. For example, if stage, all of these things here can be paid by the seller outside of the commission. Okay. So you could say the seller, I need you, this is not my house. You need to stage it. If you wanted to sell this nicely, you want to stage it. So the seller's got to come up with, $2,000, $3,000, $5,000 extra. Photography, that's part of marketing. So that's probably a cost that I will pay. That could be $500 to $2,000. Inspections, this is not my house. Seller, you should pay. That's going to be $1,500. Okay, maybe you pay first and then you get reimbursed at closing. Okay, these are different considerations you have to do for your transaction, and all these numbers all play into that. So you want to make sure you're earning enough for the time that you're committing. Okay. Closing gifts. Do you give closing gifts? IRS says you're allowed to give up to $20 tax-free, I guess, for a closing gift. Maybe you give something more. Maybe you say, you know what, you're such a great client, I want to take you out to the best restaurant in town and pay for that. Okay. Or maybe I want, you figure that out with your tax advisor in terms of what is the right way to spend money. Another good idea is you are hosting the housewarming party. Okay. And maybe you spend $500 for a housewarming party. And you can classify that potentially as a marketing expense because you're doing all the invitations to the new owners, family and friends, and you're doing this for the purpose of getting new business. Okay. So it's party, but yes, it's marketing because you're promoting yourself. Okay. At the end of the day, figure out what is the right amount that you need to get paid to do the work that you do. In today's business, in today's market, you have buyers and sellers potentially asking you for 50% of your 50% of your commission right off the top. So your 25 goes down to 12,500. And then you got to layer on these splits. And at the end of the day, you're saying, I'm not working for $5,000. That's just not worth it to me. So you might say, no, I'm not going to do it. Maybe it's not your principal. Okay. You're Neiman Marcus. You're Tiffany's. You're not Walmart. Okay. There's a value to the business that I provide. This is just within a transaction, right? There's other cost of business, such as association fees, travel fees, education fees. You're not getting paid with this, right? So from that, so let's say you're 14,000 over here. I said 5,000 is your salary. Okay, that's just you. You're taking home that 5,000. Okay, the other 5,000 was for the business. That's going to pay for your association fees, your travel fees, your education, your networking events, your certifications, all those things. Okay. Maybe you need to buy leads. Maybe you need to buy tools. Maybe you need to buy marketing. So you got to run the business right. Okay. Buy side. Buy side is the same thing. Okay. 25,000. You have concessions and rebates. You have referrals you got to pay out. And then you have team split, broker split, and then you have a net. You might have an equities purchase. And then you have different considerations on the buy side. It's actually more common that people are having to pay rebates on the buy side, okay, because they're going to compare to things like Redfin and say, well, Redfin says I only have to, you're going to rebate me like a certain amount. Well, you better check the website and make sure that that's true. Okay, Redfin does not rebate anymore. They actually are charging 2.5%. Okay, I think the buy side. Let's just take a look. I don't want to be a liar. Let's take a look. Okay, so let's see. Let's take a look. I saw this house already. I was going to sell it, but anyways, let's see who he picked. He picked a different agent called Mita. Okay. Oh, well, I did not get that listing, but it is what it is. It's an ugly house. Over here it says start an offer, buy with an agent and get $5,000 back. Okay. So there is a dot here. Let's take a look. Estimated refund. So they are giving refunds, but you got to learn more. So you got to find out what the criteria is. Okay. Buyer's agent subject fee to change. Minimum buyer's agent must exceed 1% or $6,500. So you might get somebody who's selling buys a $300,000 condo and says, well, Redfin says they're going to, give me a 1% rebate, but not all properties qualify. So you have to understand your market and your numbers so that you can justify your commission. If your commission is below 6,500, like let's say it's only 3,000, and say now from $3,000 commission, I got to pay team, broker, referral, and all this other stuff, and I'm only earning $500. No, I'm not going to do the deal. So you can adjust your commission amount to the amount that makes the most sense for what you're trying to do. Okay. All right, moving along. These are the considerations too. So if you're taking a 20% discount and the business still makes sense, as long as you look at the numbers, run through the numbers. If it makes sense, do the deal. If it doesn't make sense, renegotiate. Okay. Transaction numbers. Assuming the purchase price is $1 million. So we start with $1 million. In California, okay, so gross commission is about 2.5%. So expect to earn about $25,000 from a purchase of $1 million or a listing of $1 million. When you're writing up the buyer contract, California is pretty Bay Area is very competitive. We offer 3% deposit. So when you put into the deposit line, you put 3%. 3% is $30,000. So you should have those numbers on the top of your head. Okay. In other smaller markets, their deposit amount could be 1%, so $10,000. Even more smaller markets, you might be able to get away with like, hey, I just want to put $1,000 deposit. Okay, you can put a write-in number instead of a percent. Okay, down payment. Down payment is another number that you have to have off the top of your head very, very fast. Okay, so the client's going to say, well, what's 20%? What's 20% down payment of like 800? And you don't know. So you put into your calculator and put the purchase price 800 times 0.2. So 8 times 2 is that'll be 160. Okay, do those calculations quickly. 20% turns into 0.2. If the purchase price was 800, so 800,000 times 0.2 turns into 160. Okay. Any questions so far? Is this like easy, hard? Okay, let's keep moving then. Okay, all right. Open your phone because your phone is actually one of the most important tools in your business, right? You're on your phone for texting, communicating, chatting, whatever. So on your phone, please go to the App Store or the Apple Store and download Carl's Mortgage Calculator. If you have not done that, do that now. Okay. So Carl's Mortgage Calculator is very important because this actually will show you how the numbers work. I know you're not a lender, and this will be for discussion only, okay, or education only. So so sometimes when you're on the phone and you have a buyer, they're saying, I only want to spend 200,000 on a property. You know that they have not talked to a lender before. So you want to have them talk to a lender. Okay. So you want to ask them to talk to the lender to figure out what they're what they are potentially qualified for. So some questions you can ask are, okay, questions. I'm going to do like this. Questions you can ask. Like this is like qualifying questions, right? Qualifying. Okay. How much have you saved for a down payment? What is your current rent? I think those are the two most easy questions to ask a buyer to see if they're kind of ready to go buy. Okay. If somebody tells you, I've got $20,000 and I want to buy something. So 20,000, okay, that's good. But what is that gonna be able to buy you, right? So let's say you're looking at a $500,000 house. I mean, condo. So you're looking to buy a $500,000 condo. So open your mortgage calculator. Okay, so you put in the top 500,000, and he wants to put $20,000. So erase the percentage, and then put in the down payment $20,000. That's equal to 4%. Okay, that's not terrible. 4% is above 3.5, which is the minimum for FHA. Okay, so there's enough for a very low down payment purchase. Okay, good. Okay, interest rate, I'm going to put 4%, $30,000, and the monthly payment for that is going to be $22.91. Okay, for a purchase of 500,000, the home the taxes, the property tax is about, oh good, okay, insurance about 500, for condo, 1,000 for house. I'm going to have to change this. Okay, property tax, about 1.2% of purchase. Okay, so let's see what I'll say 5,500, 5,600 for the property taxes. So that means his his monthly payment or monthly commitment is going to be about 2,800. Okay, so income should be 2x of total. Okay. So, okay, let's just work with the numbers here on the screen because I have it, right? So they want to purchase something for 1.2. They have 250,000 cash. That means they're going to purchase all 4% interest, 30-year fixed, 13,750 for annual tax, about 1,000 for the insurance. This means that their total monthly commitment should be about 6,000. Okay. So if you consider a 50% debt to income ratio, this means their gross income between between husband, wife, or a single person should be about double this. So if they're not earning $12,000 per month, if they don't have $250,000 cash, then this is going to be a very difficult purchase. Okay. It's not like they can't find a gift. It's, of course, you can find a gift. You can get a lower interest rate. You can you choose a different mortgage program. Maybe you want to make a different kind of adjustments, but that's how you can justify this purchase. Okay. Learn this calculator because somebody's going to ask you, hey, I've got 100,000. Can I purchase this? So if this person has 100,000 and was shopping this $1.25 million property, these numbers will go up. So let's just take a look. So let's go. Okay. 125,000. Okay. Enter. And then he's only got 100,000. Okay. So that's actually 8%. So that does not include PMI. So consider PMI, private mortgage insurance. Okay. So those are different considerations. Now his monthly payment is going to be about $6,019. Oh, shoot, because the annual tax was not right. Okay, let me take that back. 13,750. And then the annual insurance is going to be 1,500. Okay, so 67,661. So if you drop the down payment down to 100,000, your monthly payment goes up by $750. So yeah, you can come in with less money, but your monthly payment is going to go higher. So if you don't have an income of 14,000 per month instead of 12,000 per month, you can't go down with a lower down payment. Okay. So learn how to use this calculator. It's actually much easier than old school HP 12C kind of calculator. Okay. Where do you find the interest rate? So check out the Bankrate website. Talk to your lender too. Talk to your lender. That was a good start too. This is just very general and it's a good starting point, starting point for a conversation. 10-year fix is 3.5. 15-year fix is 3.4. So if you were to choose between these two loans, you should pick the 15-year rate because it's lower and you can get the rate for a longer period of time. Your monthly payments will be smaller at 15 years, but you'll pay a total that's higher because you would have to pay 5 extra years on that payment. Okay. So you'll end up paying more on the interest, dollar wise. Okay. 30-year fixed is the same. It's the same. You're taking 30 years to pay it off, but this is a higher rate. So that means the longer you have that loan for, you're going to take long. Each month is going to be smaller because you have 30 years to pay it off, but you're also going to pay a lot more in terms of interest because you're paying, 15 years more than the 15-year fixed. The 5-year arm does not mean you're paying off the house in 5 years. It just means for the first 5 years, you're paying 3% or 2.9%. After the first 5 years, it adjusts to whatever the market is going to be. So let's say if the rate goes to 2% on year 6, that's good for you. If the rate goes to 5% on year 6, then that's terrible. Okay. So if you can refinance after 5 years, that's a good time to plan to do so. Okay. These ones here with the long-term fixed, it is good for if you're trying to keep the property long and the rate is good. So it makes sense. So do that. Okay. This one here is more of a gamble. You got a short-term gain, but maybe the long-term doesn't look so good. So you're going to have to predict what the future is going to hold. Is the rates going to higher or going to go lower? At this current rate, I believe the rate's going to go higher. Will it sustain? It's hard to say. Okay, going back here. Any questions on the calculator? Have you guys downloaded yet? Have you tried using it? Don't be shy. This is interactive. Okay, let's move on. Wait. Okay, absorption rate. This is another important number. This tells you how fast and aggressive a current market happens to be. An absorption rate is how long does it take for all the homes on the market to be sold? So I have another document called neighborhood sales. This is calculating comps in a certain neighborhood. So I did that exactly the same thing here. And this neighborhood happens to be a neighborhood where I live. Okay. And in my neighborhood, there are more solds on here. So this is like a chart from goes back to September 1st. Okay. So in this chart, an ideal explanation for absorption rate is actually number sold divided by number active. But in this case, it's too hard to do the solds. I actually prefer to use the number of pendings. This isn't 100% accurate because pendings sometimes don't actually close. But for the purpose of the quick calculation, pendings are fine. So in this 30 days, I say 30 days because contracts take about 30 days to close. And these are indicative of about 30 days of activity. So how many pendings do you have? I have 5 pending. How many actives do I have? I have 1 active. Except this 1 active is kind of an unusual property because the price range is outside of the typical neighborhood price and also much larger than the typical neighborhood size. Okay, this is 20,000 square feet. Okay, so I could exclude this property because it's not your typical. All right, but let's just say it's a normal property here. So we've got 1, 2, 3, 4, 5. 5 divided by 1. So 5 divided by 1 is equal to 0.2 months of inventory. 0.2 months is the equivalent of 6 days. Okay, because I did 0.2 times 30 days. So 6 days is basically about a week. Okay, 1 week being 7 days. So roughly it'll take about a week for anything to sell and it'll be gone. Okay, anything less than 6, if absorption rate is less than 4 months, you are in a let's see. Let's rewrite this. 0, 6 months, no, 4 months. Seller's market. 4 to 6 months. Balanced market. Greater than 6 months. Buyer's market. Okay. However, in the Bay Area, people feel that if it takes a month to sell anything, that means the time takes more than a week to sell, then people freak out and say we're in a buyer's market already. But we're far from a buyer's market at this moment. Cash flow. Will the property cash flow? That's an important conversation, especially if you're working with investors. You want to make sure that you're earning money for the property that they're going to buy. Okay. So let's take a look. So let's say rent is $7,000. Okay. Let's arbitrarily pick rent as being $7,000. So from that rent, you have 7,000 times 0.6, 0.06. And how much is that going to be? $7,000 times 0.06 is $420. Anna, what's your management fee?
My management fee
Yeah, for your leasing.
for my leasing?
Yeah.
Oh, you mean the broker's fee?
No, because if you're property management, that means every time your client asks you, hey, please rent out this apartment. And then from that $7,000, how much do you, as a brokerage, collect from that client per month?
Well, it's not a brokerage. It's managed by First Realty. So, but I'm on the leasing side. I don't do a whole lot of management stuff, but
So tenant placement.
Tenant placement.
So you do tenant placement. You place the tenants. You don't actually do the calculation for the cost per month.
Right, exactly. I just take care of the leases and approvals.
Okay. So in management, okay, so in property management, okay, rent is going to be about, let's just say that rent is $7,000 for this 1250 unit. And there's going to be a management fee. A management fee is usually about 6%. Okay, so let's call that 420 per month. Vacancy is going to be about 5%. Okay, so let's call that 350. And no, it doesn't. The apartment does not be rent. Is not vacant for 5% of the month. It's like looking at a whole year, and okay, let's say for half of the month it's going to be vacant. So that's where that 5% comes from. But you got to calculate that as a cost. So in this case, 7,420, and then you have maintenance. Maintenance going to be like, let's say 5%. So that's going to be same thing, 7,000 times 0.05 equals 350. So 7,000 minus 420 minus 350 minus 350. What's that going to be? Minus 420. Oh, shoot.
Mine be like
Minus
580, 5,800.
Is it? Okay.
Maybe
500, 5,800. You said it, so we'll just, I think so. My calculator's not behaving. So it's just 7,000 minus 420 minus 350 minus 350. Okay, 5,880. Okay, that's my net, right? This is terrible because my monthly cost is $6,000. The mortgage cost is 6,000. Okay, so let's do that too. Minus 6,003. So this is the 6,003. Negative 123. So does this positive cash flow? No, it does not. So every month, you, the buyer, is going to be probably contributing $100 to $200 per month to make this rental work. Okay. So is this a good deal? Probably not. But different markets are different. So some investors like to buy in California because although they're losing, $2,000-3,000 per year, the appreciation is going up by $20,000-30,000. So, for the loss of this price per month, they're gaining tens of thousands per month. Okay. That is a conversation you have to have with the buyer and make sure that they're happy with that number. Okay. Appreciation. How much does it appreciate? So let's say $1 million times 0.01. No, 3. So in 1 year, if it increases by it's not that. It's that. Okay. So in 1 year, it gained $30,000. Okay, so it increased by its existing value plus an additional 3%. Okay, so $1,030,000. Okay, now other calculations is the ORTC online net sheet. So let's go to that. It's over here. Oh, thanks. Okay, bye. Okay, let's take a look at this. So this is a net sheet. Every state is going to be different. So make sure you check to see the correct net sheet from your area that you're practicing real estate. When you're calculating for the buyer or for the seller, they're going to want to know that what their closing costs are and make sure that it satisfies that they have the money. So a lot of people say, oh, I'll just bring in 20% down payment and that's it. Well, there's also sometimes a 1.5% closing cost fee. Okay, because the lender might charge you money. There might be escrow and title fees. You got to run the net sheet so that they know how much money they come in. If they come in with exactly 20%, they're going to not make, they're not going to be able to close the loan. Okay, or the purchase. So make sure you learn how to use the net sheet. This is a different conversation. Go ahead and play with it. Let's just do it now. So seller, John, pineapple. Okay, in San Leandro, where I live. Okay, 9.4. Okay, sale price $1 million. Okay, seller credit to the buyer, no credit to the buyer. We're going to close at the end of the month. Okay, he has a mortgage balance of 750. Okay, he's got to pay commissions. You can break it out. Okay, 2.5 there, 2.5 there. Annual property tax, we're not going to calculate that, and calculate. And these are the numbers. Okay, so out of $1 million sale, 750 goes back to the bank that he has to owe. $60 demand fee, $45 reconveyance fee, $50,000 for the 2 commissions. Okay, a notary for $1,000. And in the city of San Leandro, there's $1,100 county transfer and a $5,500 city transfer fee. So if you don't run the net sheet, the seller is going to complain to you and say, wait, I thought the commission was all I had to pay. I didn't know I had to pay this other $7,000. This caught me by surprise. I was needing that $7,000. So you need to have this conversation with the buyers and the seller so that they're not at a surprise. Okay. Let's look at the buyer in this case. We're going to run the numbers in the other direction as the buyer. So San Leandro 2, $1 million purchase. Okay. They have a loan, but I'm not the lender. Okay, I'm going to say that their loan origination fee is going to be about 1%. Is it 1%? $10,000. Okay, so maybe they did or did not know about that. So calculate. So as the buyer, oh man, I have to type in that. Okay, fine. Oh, closing date. Okay, closing date. They're closing it of the month. Okay. So on the buy side, okay, they've got to get the loan charge, underwriting fee, credit report, appraisal fee, flood cert, loan origination fee, title insurance, escrow fee. Wait a minute, I just thought 20% was all I had to pay. I was going to bring in 20,000, 200,000, but now it says I have to bring in 222,000. That's 22,000 more than I thought. Okay. So this is a very important calculation you got to do. If your buyer has a lender, the lender will probably run these numbers for them. But in the case that your buyer's lender is not that good, he's going to get caught. And because you as the agent are working with the client, they're going to blame you for not telling them. Okay. So you got to make sure you got to get that done. All right. So let's see what else we got. Netsheet, we talked about burn rate. If you are in this business full time, you got to be honest with yourself and look at how much money you have in the bank account and how much it costs per month to run your life and divide it, because that will tell you at what point you are sustainable. So if you've got 50,000 in the bank and it costs you 10,000 per month to run your life, you've got about five months of expenses in the bank. Okay. So hopefully you'll be earning a positive number. So your burn rate goes the other direction. Your turn into an earn rate. Okay, guys. That's pretty much a wrap up for this conversation today. I'm going to go ahead and stop the recording and open up for questions. So let's do that. If I can find it. Where is it? Stop recording.